Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really appreciate all of those that join us and ask questions and what have you. Our objective in this show is to try to help people get a more successful retirement. You know, whether you're 20 years old or 40, looking forward to retirement, or already in retirement, a lot of the things we talk about are things that should be able to help you, really get your retirement to the level that you want. We work on the retirement planning aspects, the tax planning, and the asset management. We see those as the three big areas. We believe that the more you know about those three areas, the better your retirement's going to be. Even if you have an advisor like us, working with you, it's still so much better when everybody's kind of on the same page. So that's what this channel is about. So if you'd like to continue to get content out of this channel as we post it, and we're really active in posting different videos, you can just subscribe, hit the subscribe button, hit the little bell. You can send us your email at asktom@talkmoneywithtom.com, or you can even send it a chat that we have here, and or set up a time to meet with us. You can go to our website and hit the book appointments and schedule a 30-minute phone call or video. So for the show format here, we're going to do kind of a question and answer. And so you can send in questions at any time at the asktom@talkmoneywithtom.com email address. You can put it in a chat. And Eason, who's here with us also today, is one of our other advisors. He'll be gathering those questions and asking them, and then I'll try to answer my part, and he'll fill in some of the other pieces, and we'll go back and forth a bit and try to flesh out the whole concept. So again, this is for purely educational content. We really enjoy doing this, and so glad that you could join us here today. I like to start off the show with a summary of kind of what I saw happening in the stock market this week. I found this week to be very interesting. There's a couple of things going on that seem to really be, coming very clear as to why the market is doing so well. And what we're seeing is that, essentially the beginning of October, when they said that they were going to resolve the debt ceiling, at least for a little while, the market started to come up, and it's essentially been going up every day, including today. Very, very hot market. And so one of the things to keep in mind is that there is a momentum that the market has. It's like a giant ship. And once it gets moving in one direction, especially this quickly and this hard, it's difficult for it to just immediately turn around. So we should get some carry through here for at least the short term. So that's a good thing for all of us that are investors right now. But this week, really the key catalyst event, in my opinion, had to do with the Federal Reserve meeting on Tuesday and Wednesday, and then Chairman Powell coming out and talking as a little speech and a question and answer. I thought there was some very interesting pieces. One thing to keep in mind, the Federal Reserve is very, very important to the stock market, and they also have very good access to data, so it's interesting to listen to them and hear what they're talking about. And what Chairman Powell was talking about was the issue of inflation predominantly. And so they're seeing the economy, moving along at a good enough pace that they're going to start cutting back on the bond purchases. They've been purchasing $120 billion worth of bonds every month. They're going to cut back about $15 billion a month starting here in November. And by roughly June, they might be done. They might do it faster or slower, depending on what happens. But their big issue is running around inflation is that we're seeing a labor pool that is not coming out to work. So the number of jobs created in August and September were very low, a lot lower than expectations. And he talked about how, they expected that job growth to be much higher, partly because the $300, extra unemployment was disappearing and school was restarting. And it really didn't help. He said that the real issue seems to be the Delta variant and people being afraid to come out to work or unable to come out to work because they can't find childcare. He talked about how the childcare business has been really struggling to try to find people to work in that business. Also, some people are afraid to send their kids to childcare. So as the virus comes down, he was saying they're very curious to see what's going to happen in an environment where the virus is lower and people aren't as afraid. Well, we're starting to see some effects of that. So the virus is down. In October, the number for the new jobs was just reported just a few hours ago, 531,000 new jobs. And, the expectation was for 450,000 new jobs. So actually we did better than expected, which is really good. And so that's a big deal. As this virus comes down, we've got the scenario where people can come back to work. And he was talking about the supply chain issues being related to the labor issues. So, it's essentially impossible to make and deliver products at a higher rate if you can't get people to come out to work. And so this is where all of these things are coming. And we had another interesting piece of news today that might help this labor issue, and that Pfizer has an antiviral drug that in testing is 89% effective against people going to the hospital or catching or dying from the virus, even after they catch it. That's a that's a game changer. Essentially, what that would mean is that even if you weren't vaccinated, you might be able to, have fairly minor symptoms if you can take this pill. So we'll see how that works out. That's still in testing and what have you. But that might help this scenario where we get more people back to work, which then could help the supply chain issues. They expected the supply chain problems and bottlenecks to continue through maybe next June. But they were expecting those to start to mitigate, start to come down. And with that, they expected inflation to come down to a certain degree. What has happened here is really fascinating. We have this massive demand we've been talking about since this time last year, this pent-up demand that's coming through. And we're seeing it come out, and we're seeing a huge amount of, demand for different products and what have you, and not being able to meet that demand. So think about this: in a perfect world, the virus stays down, and or this new antiviral drug comes out and it actually works, and people start to come back to work, and we can actually start to meet the demand. You're going to see company profits do really well in that environment. So, we have a situation where these two big bills are being worked on right now. They might even be voted on in the House here, the infrastructure bill and the Build Back Better program, both of which have now been set up so that they're not as onerous on corporate taxation or capital gains taxation, both of which would benefit the stock market. That's partly why we're seeing things move. But if those get passed, I think we'd see some kind of bump there also, just because that's some more stimulative money coming into the market. They talked about keeping interest rates low still until maybe the second half of next year. So that'll be really interesting to see what they do with the Fed funds rate. But this is a really, really fascinating time to be an investor right now, and things are going really well. We are seeing the companies that can operate in this environment of potentially low labor, higher inflation, supply chain constraints. We're seeing those companies that have been able to demonstrate their ability to do well, doing even better in this upturn. So your Teslas, which for some reason is able to deliver these cars, even though Ford is having trouble. You've got the situation with NVIDIA that's able to deliver, at least at fairly good rate, their chips. And you've got, companies like Microsoft that can operate in this environment just like they did during the pandemic, all having fantastic runs. So we actually made some changes to our portfolios to move into some of those areas that are doing quite well. Get ready for, the electric vehicle car situation that's happening too. So really, really fascinating time frame for the market. And I look forward to being able to see, what's going to happen next week, and really keep that positive thoughts going. The positive thought here altogether has won. All right. I mean, all the way since March of last year, those people that kept a positive outlook on what would happen with this market, focused on the basics, focused on the fact that interest rates are low, taxation is low, have done really well. And then you just basically look for those little trends to emerge and try to, push some of your money towards some of those trends. And that's basically what's happened so far. So, we'll see what happens, but things look very good. Could have very good fourth quarter earnings because of what we saw with the third quarter earnings. These companies are really doing a great job. So look forward to talking to you about that next week. We'll give you your summary then. Thank you very much. All right, Eason, let's talk about what's going on in terms of the questions.
Yeah, sure. So our first question is kind of just highlighting. So you made some changes to the portfolio, and a couple of them where you put NVIDIA and Microsoft into the portfolio. Why'd you pick them over like other high performers, like such as Tesla?
Yeah. Yeah. Well, I look for trends. I look at it like 75% of our portfolio is in the broad market. That's what we've done for a long time. We deviated from that last year and part of this year, actually, just because of what happened with the pandemic, but we're back to that. So the other 25% of our portfolio is for targeted indexes, and we're looking for targeted situations. And I look at that as sort of like surfing. I'm sitting out on a surfboard and I'm looking for a wave, and I want to be able to kind of capture that wave. We've had trouble with that this year because the waves have been just ripples, essentially nothing that you could ride for very long. But we're starting to see some pretty strong movement, especially in these companies that can do well in this environment. And I think that we're seeing, again, a little bit of a narrowing. So if you have trouble with supply chain and it's going to really hit you, like let's say Ford or Apple, that might be an issue for those particular stocks. Although Ford is doing well, that's because their electric vehicle thing is being very well received. But nonetheless, those companies that aren't as affected or have been able to, operate with this environment, which includes Tesla, have really done well. Now, I'll take Nvidia and Microsoft, for example, which we added to some of the portfolios over Tesla only because of the volatility. I'm managing people's net worth, their life savings. And so, Microsoft is very similar risk to the overall market. We bought a clean energy, electric vehicle ETF called iDrive, IDRV from iShares. Again, fairly low standard deviation on both of those. Nvidia has a bit of a higher standard deviation, so that's in less portfolios, more aggressive portfolios as far as that goes. But I really like these companies. They're fantastic. They've got huge market shares, great cash flow. Their earnings are ridiculous. They're expensive, but I've seen several studies. Matter of fact, I just saw a study recently showing here's the top 50 stocks since 2007. Two out of the top three were the two most expensive stocks in 2007. So if you can still buy expensive stocks as long as their earnings continue to grow really fast, which these companies have been able to do, and I feel pretty good about Nvidia, especially. They're apparently back ordered essentially through 2022, and so the more that they can solve the supply chain issues and the labor issues, the more they're going to be able to meet that demand. And it seems to almost be insatiable. They're in a lot of different categories with Bitcoin mining and gaming and all of these different areas. So that's an exciting area altogether. We'll see how it goes as far as that goes. But that's why I could have bought a semiconductor ETF, but that would include Intel. And a lot of them are market cap weighted, and Intel might be your biggest holding. Intel's really been struggling. They've been getting hammered by AMD and Nvidia in terms of just competitive world at the moment. Now, I don't hate Intel. Maybe you do it as a buy low, but when you buy a whole basket, that's one of the problems. Sometimes you're getting some pieces that just aren't doing that well. So I wanted to carve through that and just get a couple pieces that were, clean as far as that goes, that didn't have massive volatility. Nvidia can be a bit volatile, but again, that's for our more volatile portfolios. But yeah, I'm very excited about that. So far, the results have been good. Nothing against Tesla, that's for sure. But just from the volatility standpoint, there's certain things that I can't get into just because they move too much.
So, so like the reasons you kind of like picked NVIDIA is like you want something that kind of outperforms the market and its kind of general industry in returns without like overweighting the risks too much, kind of. Is that your opinion?
Yeah, I mean, if you look at it theoretically, the one big issue that's happening in the supply chain is the number of chips. And so here's a company that makes chips, and so the demand is high. And from what we're seeing, people are paying more and more and more for these chips. That's an inflationary situation, but that's also a more profitable situation for a company like Nvidia, assuming they can meet that demand, right? Which they have been able to do at least adequately to the point where their earnings are still growing. So yeah, it's a matter of in a hot market like this when things are really going well, being able to kind of get in there and pick a couple of names that might participate. Again, there's bound to be some small stock somewhere that does some great thing, but I've got to stick with things that have a less volatility. Just to make sure.
Yeah. I know buying a graphics card from NVIDIA now, basically you're paying your arm and a leg for it. So I can see why demands and revenue for them is so high.
Yeah, they're in gaming, right? They're in the Bitcoin mining. Made a lot of money last quarter off Bitcoin mining. They have some specialized design chips for Bitcoin mining. They're in the autonomous vehicles. I guess they're the main chip that goes in the Neo electric car. That will be part of the autonomous driving situation there. So that's a good thing. And they've got a lot of pieces that are working in very hot areas. They provide chips for Amazon for their cloud service. Which is a huge growing area with this pandemic and people working from home. There's more and more cloud storage that's happening, and operations of different software programs out of the cloud. So they've got leads in all of those. They're probably one of the best semiconductor companies in the world really at this point. Taiwan Semi is the biggest and probably the best, but suffering from the exposure to the China situation, even though they're in Taiwan, but still hasn't been doing nearly as well just on a price basis. So anyway, I think NVIDIA was the choice there, at least for me. There's lots of different choices out there, but Microsoft we've already had in the portfolio. We have a big holding of Microsoft. We just basically added to that to some of the accounts, and that's been working out really well for us altogether.
Yeah. So this is a planning question. Is there any benchmark I could use to kind of guess my life expectancy? You know, my mom's lived into her 90s, but my dad died in his 70s. Just kind of, is there a good way to kind of estimate for Social Security?
Yeah. Yeah, actually, life expectancy is a really interesting area because there's two areas you really would, need it. Number one is calculating your overall financial plan because, you're trying to make sure you have enough money for the rest of your life. Well, what's the rest of your life? That's a really tough one to figure out. And so we can use some averages and those types of things for that. The other aspect is for Social Security. So if you're going to do an adequate analysis of Social Security as to when to take it and how to maximize it, it really would help to know exactly how long you were going to live so that you could kind of figure that out. And so there are some rules of thumb and what have you, but I've actually done a fair amount of research on this, and there really isn't anything that is as admitted by a lot of the authors of these studies. There really isn't anything that's that good at it, at showing your life expectancy. It's too complicated. But one study that I read that seemed to be fairly well received talked about how you would, if you were a female, you would take your mother's age and how long she lived, and you would add 7 years. If you were a male, you would take your father's age and add 4 years. Now, again, you got to consider, hey, my father passed away early, because of a car accident, and that's not going to work very well. But so there's some mitigating circumstances there. Um, and some of it, the biggest challenge you have in financial planning as a whole, whether that's Social Security maximization or the retirement planning, is, living long, right? I mean, so generally speaking, I will try to plan for something longer than somebody thinks, just so that they can make sure that, if they do live that long, they're still got money. They don't run out of money. But Social Security planning is a little bit different, because if you don't live that long and you waited, then theoretically, you could have taken it earlier and gotten more, right? So two different stories, but really it's very difficult to figure that out. However, I have a lot of clients that seem to have some expectation. And sometimes that's what we work with, well, my parents live really long. I expect to live long, or, they didn't, or what have you, people's current health situation. So, but it's very difficult actually to figure that out really well. But, what we do, as Ethan, from Social Security planning, we'll use something really short, some average, life expectancy, and something long, and do all three. And people can then kind of see the differences for the recommendation for when to take it, right? Based on those three. And then you can kind of factor in your own feel about that. So maybe you end up with the average or what have you, but, and it'll tell you, what the optimum scenario is to take Social Security from, which can be very important, in my opinion.
Yeah, and when you're doing this maximization, you kind of have a break even age. So
Yep.
once you hit a certain age, and like some I've seen is like 76 or something like that. So like, you only have to you don't have to live too far out to actually break even on that
Yeah.
calculation.
I mean, basically what you're saying there is I could take it at 62, uh, or full retirement age, say at 66 or 67 or something like that, or I could wait till 70. So let's say I wait till 70 and I could have taken it at 62, for example. When would I break even? And so if the break even age is, say, 78, okay, I got to live to 78. That's not that old. But for some people, they don't think they're going to make it there. So maybe they want to take it earlier. For those that think they make it past, then they actually are better off taking it at age 70. So, but that's part of that calculation, basically.
Yeah. So another investment question, when you review like someone's overall portfolio, what do you look for and what are some red flags that you can see or notice?
Huh. Well, one of the interesting things, of course, in our valley here that we see all the time is high concentration, specifically in a single stock, the company that they work at currently or used to work at. And oftentimes, because the valley here is so successful, those are pretty good stocks. You worked at Google, you worked at, Cisco or Intel or whatever. These stocks have done quite well. And so it's an interesting conundrum because, theoretically in the, overall thought process of financial planning, concentrations are danger, right? Because you can have this scenario, rule of thumb that we always see all the time is shouldn't have more than 10% in that concentrated position. I've seen a lot of people with more. And so that's one thing we do look at. I try to talk, I'm a big believer in wealth creation by keeping those stocks. And I've had a lot of people be surprised that I've said that because every other advisor trying to get them to sell it because that's how they make money, put it somewhere else that they get paid on. I look at it a little bit differently. There's all kinds of things you can do to try to protect that. You can sell some covered calls and put in some stop losses. You can do all kinds of little pieces on parts of the portfolio. But one of the ways I look at it is sort of like a fruit tree. So let's just say, $1 million is the number we're pretty happy with. And even though it's a little bit high concentration and it grows to 1,200,000, maybe we sell 200,000. And then every time it gets above 1 million, we sell some. And basically then we put that into other diversified portfolio pieces. So I would say concentration is one big issue. But then past that, if I'm looking at just kind of the rest of the portfolio or a normal portfolio, I'm really interested to see how that portfolio did in different environments. So take different downturns. How did it do in the pandemic downturn? How did it do in the big bounce back from the pandemic? How did that portfolio do just recently, September, October? How did it perform on the downside? How did it perform in this bounce back? And so, because you can get a portfolio, it's amazing. Sometimes you see they did worse on the downside and worse on the upside, right? So that's a bad portfolio, or one that did a little bit better on the downside, but really, really loses on the upside, right? So I'm trying to look for that balance because when we compare portfolios to the market, we're using, I think, really good index. We're using the Vanguard Total Stock Market Index, which is basically most of the stocks here in the U.S., and the Vanguard Total Bond Market Index, which is a whole bunch of bonds here in the U.S. And so if you're at a 70%, stock, 30% bond, we'll take that mixture, 70% total stock, 70% total bond, and compare. Because honestly, anybody can go out and buy that. Anybody can go to Vanguard and buy those two indexes. And so if you're not beating those, and you're losing on a regular basis and you're not winning on the upside, and you're not winning on the downside, and so then we can kind of compare that to what we're doing in terms of, our performance over the last, 3 years or so, dealing with that. So that's one of the things that I look at pretty heavily is just kind of that performance in these different market cycles and different situations. Uh, then ultimately it comes down to some of the diversification, although most people are, once we get rid of that concentrated position, look at the rest of the portfolio, most of the times I see a pretty decent mixture in today's world. It's not too far off of all of the different pieces. The last piece would be expenses. And I don't see this as much as we used to, but still see it sometimes. People have internal expenses. They just don't realize they're there. They're hard to see, that are super high. And so it's very difficult. If you buy those Vanguard funds, they're, almost free. They're 0.03% internal costs. If you're paying 1% internal cost or something crazy, it's very difficult to keep up to that. So anyway, those are some of the pieces that I would look at in kind of a portfolio analysis, at least off the top of my head.
And so when you have these like giant pieces, like you've used cover calls and other things in the past to cover them, um, do people ever get fearful of having such a large position in, say this one stock? Because, it generates wealth. Like a lot of people become millionaires because they had this one kind of home run.
Yep.
But if that home run disappears, it kind of could massively affect their financial plan.
Yeah. Yeah, that's right. And we can stress test that. We can take their financial plan, find their probability of success in the current situation, and then we can go into the stress testing section and say, hey, what if that one concentrated position dropped in half or disappeared? Very unlikely in a lot of these big cases, but how much does that impact the plan? And sometimes it's not a big deal, and sometimes it is. So when it really is, then yeah, we need to talk about kind of what we want to do with that. And it's this balance. I mean, I've had clients that had like $500,000 worth of one of the biggest tech companies here that's now worth $6 million, and all the way along, advisors have been coming in telling that person to sell, 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 and so and good thing they didn't. I mean, it created a whole different scenario for them in terms of that wealth. But maybe at some point in time, you'd pick a point and say, okay, this dollar amount is enough. I still at 5 million in that case. And so I'm going to sell a piece off, and then I'm going to keep that 5 million. If it grows back to 5.5 million, I'll take off 500,000, whatever it is, right? You just kind of use that. And then what I like to do in a perfect scenario there is to use a covered call, let's say at 10% above the price for a monthly covered call. So if the price goes up 10%, it would sell, which we want to do anyway because it's extra. But I would put 5% below the price a stop loss. So if it does fall some, we're out, we'll get it. And that way I could even keep that piece that I'm trying to sell for a while and generate income off of that covered call until it finally jumps up and gets called away. And that's perfect. And I've done that, several times with different situations. And that's one of my favorite ways of kind of selling off the fruit, so to speak, off that fruit tree is that concept. And I think, because it generates an income, allows you to keep that fruit piece for even longer. And you've got some protection if it does fall, right? I mean, there's a stop loss there. So so anyway, that's there's lots of different strategies for how to handle these concentrated positions. I think it's a really important component. I personally don't believe, unless the company is falling apart, that you should be selling these off just because some advisor tells you that it's a good idea to diversify. Um, Obviously, if it's your only holding, you need to do something, but that's not usually what I see. People usually have their company stock and maybe a 401k. So there is some other assets that we can diversify. And obviously, they have a house, that they're living in here, which could be, pretty valuable. So, yeah, interesting area.
So another hot topic is refinancing. I know you're personally going through a refinance of your own. Could you
Yep.
kind of describe what the process is like? Have there been any curveballs, or what kind of documentation are you having to submit?
Refinancing. I've done several. I helped my mother with her refinancing several times. I was kind of the family finance person, so I was always helping people with those things. And I am refinancing my own place right now as we speak, this house that you're looking at. It's a brutal process. It just is. You go through kind of the salesperson to finally getting to the underwriter, and the underwriter has a whole different, criteria for what they're looking for. I would say personally, because my wife and I, it's a pretty good savings. We're going from 4% to 2.75, which I'm pretty happy with. And but before we started, we both said, okay, this is going to be tough. It always is, and just accepting that for starters. And so they'll come back and ask the same darn questions over again, and then there's sometimes even a final underwriting where they start over. It's pretty amazing as far as that goes. But I will say one thing to keep in mind here, and I've been saying this for a while. is that there's a pretty good chance here as the Federal Reserve cuts back on these bond purchases. So these bond purchases that they're doing, 120 billion a month, are designed to keep interest rates low so people can borrow, and that would stimulate the economy, right? So companies can borrow more and people can borrow more or refinance and save money, put that money into the economy. So as they start to cut back on these, purchases, theoretically interest rates should start to come back up, and you'll probably see mortgages moving back up in that time frame too. So if you are going to refinance, it's a pretty good time to do so. It's why I did it. Um, and I just saw an article by Bankrate saying that 74% of the people have not, homeowners have not refinanced in the last 3 years. So there's a bunch of people that haven't taken advantage of these low rates. And there's lots of reasons why you might not. First of all, it's a pain to do, but I would consider doing it here, pretty soon if you're going to do it, because these could, I mean, I'm going to pay 2.75%. When I first built this house, I thought I had a really good deal when I got 8%. So, we refinanced it down to 4, which I thought was a great deal, but 2.75, that's a really good deal. So, anyway, from my perspective, I think that's something worth going through the process for. Um, I don't know, if there's a number, a 0.5% or 1% or whatever it is you might be saving. It just depends on your tolerance for all the documents, because they ask for everything, tax returns and all the investment statements and what have you. I will say another thing too that's interesting within my clientele. I have a lot of very wealthy clients who have trouble getting a refinance or getting a home equity credit line because they don't have a job. And boy, these banks are just locked in on this job. And if you don't have that, sometimes it's difficult. So we've had to do all kinds of different things to show income. Take money, $2,000 a month out of an IRA for a while, so that you're showing income. And the bank guys will usually help you, or the mortgage broker will usually help you with that. But be aware that that is an issue within the retired community, even if you have a lot of money. Because sometimes getting a refinance or a home equity credit line set up can be a little bit of a challenge, but it can be done. There's some strategies to try to show income that seems to make the banks happy, and then you can turn that income off later if you need to. So anyway, that's part of the game.
Yeah, the nice thing about mortgages is once you qualify, unless you default on it, they really can't do
Yep,
anything to you.
that's right. Yeah, it's nice, and you can lock in some really nice rates right now, and then maybe take the savings that you're doing and continue to pay the same payment even, and pay down your mortgage even faster, which I'm a big advocate of in retirement, is trying to get that mortgage down to zero. Even at 2.75, I still would like to pay my mortgage off, before my retirement, just because I don't want the fixed payment that I have to pay. I want more flexibility in case my income sources or the stock market crashes or those types of things. I want more flexibility. I want to have my fixed cost be as low as possible, because I've just seen within my clientele that's the most successful retirement and most gratifying. Um, I probably could make more than 2.75% a year on this money as an investor, but I already have investment assets. And so it's really just a matter of structuring my finances the way that will make me most comfortable and most successful in my retirement, or anybody's retirement for that matter.
Yeah, and so sometimes having this is better than being perfectly optimal if you
Yep.
kind of have to
Yep.
sacrifice some things.
Yeah, let's face it. Great Depression, the stock market dropped 86%. So if you're paying 2.75, but you just lost 86% on your investing, and you didn't pay down your mortgage early or didn't pay it down, before retirement, there are periods of time where we could make a lot less than 2.75%. And we'd be pretty happy that we didn't have that payment in that environment. So and that's what I plan for in retirement. I think about those type of situations, because you will get to a point where you can't make money anymore. Nobody wants to hire you. And so, you could really have a really huge impact to your lifestyle. So keeping that cost basis, that fixed cost basis down, I think would be really, advantageous for that scenario. Trying to sort of bulletproof your retirement in that regards, I think is important.
Yeah, so we got another market related question. How does inflation affect companies' reported quarterly earnings?
That's a good question. How does inflation impact quarterly earnings? Okay, so think about this. If I'm a company and I have inputs, which would mainly be labor and materials, that I need to pay for in order to produce my product. It could be a service, it could be a goods, whatever. If I have increasing costs on that materials and labor, and I can increase my price, essentially the same. If my costs go up 5% and I can increase my price by 5%, and the market is hot enough and there's enough money out there so that the demand stays the similar, it won't have any impact. And we sort of saw that, in my opinion, in this third quarter report. People were able to pass along the increases in their companies, were able to pass along the increases to the consumer. And the consumer is so, flush with cash right now as a whole that they were willing to kind of pay those prices. Now, there's some potential end to that, right? Where the price can't really go up much more. And if your internal costs and cost of production continue to go up, that's where it could squeeze the earnings. Because now if I'm paying more and I can't raise my price, that's the issue. And that's what scares the market about inflation is just, this ultimate period of time where companies aren't able to increase price, but their costs of producing go up to the point where it starts to really squeeze their earnings. The one way that you can get some of that back, so if the cost is going up, if you can become more productive, in other words, create more product with less inputs, especially less humans, and so what they call productivity. And that is one thing that people aren't paying enough attention to, in my opinion, in the inflation argument right now, is that productivity has been skyrocketing. The pandemic created a scenario where companies had to invest a lot of money in technology, and that is now paying off as a increase in productivity. So even if my costs are going up, but I can make them for with less, hours of work or what have you, that could offset some of the problems I'm having with my earnings. So these companies are really good. I'm telling you, they're really, really good at figuring out how to get those earnings to come through. It's their main goal in life, and they're quite good at it. So I wouldn't count out the companies. I don't tend to react to what's happening, in the future, because I don't know what's going to happen in the future. I'll react to what's happening today. And today, and even in the short term here, it looks like companies are doing a really good job of dealing with this inflationary environment, and their earnings are still very good. It was up over 36% in the third quarter. Fantastic earnings growth, really good.
So I guess one of those end of the year questions is what should I have on my kind of annual financial checklist?
Oh, okay. So end of the year financial checklist. Yeah, that's a good question, actually. There are some things, as a matter of fact, we get pretty busy at the end of the year because there's a whole bunch of things that we might be able to do. So obviously, one of the things you want to take a look at is, do you have anything at a loss that is in a taxable account? Uh, and you might want to sell it and take that loss and kind of harvest. They call it tax loss harvesting. You want to harvest that loss, and, maybe you have some gains that you want to take at the same time to kind of offset. That would be fine. Or you can just keep those losses. And you'll be able to take $3,000 of those losses off of your tax return as a deduction, or write it off against future gains. I think up to 15 years is how that works. And so anything that you have as a loss in a taxable account, in my opinion, it needs to be something worthwhile. If I've got $100,000 in something that's down $100, I'm not going to sell it just because I don't want to deal with it. But if it's down $3,000 or something, I might sell it. So maybe I would move from, short-term government bond fund that was down a little bit to a short-term, Treasury inflation protection securities ETF. Similar scenario, but hopefully different enough to get through, what they call the wash sale. Or you can just sell something and wait 31 days and then buy it back if you're interested in buying it again. So that would be one thing, is tax loss harvesting. The other thing, of course, is required minimum distributions. So for those of you that are over 72, you have to take money out. If you haven't taken it out yet, you should be working on that now. and making sure that you get that completed before the end of the year, because there's a penalty of 50% if you're supposed to take out 10,000 and you don't for some reason. Be a $5,000 penalty, so nobody wants to pay that. Oftentimes you're able to give to charities. You're able to give to charities through your requirement of distribution. It's called a qualified charitable distribution. I would really be working on that right now, because the charity has to cash the check in order for it to count as part of your requirement of distribution. So, for example, if I need to take out $10,000, I can give 1,000 of that to the charity, and as long as they cash it, it'll count as $1,000 distribution out of my IRA. But only 9,000 now will end up on my tax return. So I just got rid of $1,000 worth of income, and I was going to give 1,000 to that charity anyway. So that's a really efficient way of doing it. But if they don't cash it until next year for some reason, so that's why you got to kind of get early on the charitable contributions. That's true in general, even for a normal charitable contribution. The charity needs to cash the check. That aspect of it is important to work on too. So those are a couple things that jump out at me as year end. Oh, Roth IRA conversions, right? That's what we're kind of busy doing right now. So obviously often wait till the end of the year for those, because we want to be able to see, how much taxable income somebody has, how much room under one of the tax brackets we have to do conversion. And so that would be another thing that's on the checklist if you're going to do any Roth IRA conversions. Obviously that needs to get done now too.
One thing that occasionally comes up is also if your 401k plan is, are you going to make any changes to the portfolio? Are you going to up your savings? And usually at the end of the year is a good time to kind of, readjust that.
Yeah.
Because like next year you can save $1,000 more into it, just with the general index going up.
Yeah, that's right. So it was 20,500, something like that, I think,
Yep.
for the new number. So that's good. That's for 401k contributions, plus a match, hopefully, if you get one. Yeah, those are good things. I mean, generally speaking, what we do see an awful lot of activity around finances in kind of February, March, because people are getting ready for the tax returns. And that's when they do a lot of looking at their holdings and kind of analyzing and what have you. But there are things that you need to do before the end of the year to impact your tax return, because you can't impact your tax return, for 2021 in February, March of 2022. So you need to do that now. Yeah. All right. Well, that's another great show. I really appreciate everybody coming and watching. And again, if you want to subscribe, hit the subscribe button. You can send us your email address. You can set up an appointment by just going to our website. We have a book appointment button. You can set up a 30-minute appointment and talk to us, see if we can help you. And I really want to thank everybody for coming this week, and I've had a really good time. These are some really good questions, actually. Some thought-provoking issues, hopefully. Again, we're trying to help everybody have a more successful retirement. And again, I